So I had a question on whether I could take two stocks that were not from the same sector, but had something uh, had the same correlation. I know that pairs trading usually involves two stocks that are usually in the same sector, but what I questioned was whether I could find two stocks that were relative in price because usually when you tie capital to one stock, you have to tie the same amount of capital to the other stock that you're doing the pair trade with. And sometimes, like, say you want to long Apple at, say, uh, uh, like, say you shorted Apple at 700, but at the same time, you wanted to protect that with the Google stock. It might be a couple $100 less than that. So there would be a kind of like a difference in shares when you did that. And so I went ahead and downloaded several stocks relative to their price. And I just wanted to see whether I could find some sort of correlation between these two. And I found a good pair, which is Radio Shack and Zynga. Their prices are kind of like they're within range from each other. They're not too far apart. Um, so how you want to compare two different stocks is first you download data. Make sure they have the same starting date and same ending date. So how you do that is just go ahead and click correlation, um, which is a Coral. I guess that's how you spell it out. And you take one stock's closing prices, which are E2 down to the last one. Um, I think this is about. So I went as back as I went to February 12th, no, 13, February 13th of 2012, and down to March of this year. And the last row is 267. But I'll go ahead and just click on to 500, just in case later on you want to add data. You'll have room for the correlation. It doesn't really factor in too much, leaving these spaces blank because we're gonna offset them by um, Zynga's closing prices. So how this works is click on the first your closing prices for one stock, and then hit comma, and then do the same thing for the other stock you're comparing. So just highlight it, and again we're gonna click 500. We're gonna type in 500, and what it's gonna do is gonna calculate. It's gonna calculate. It's gonna give you a fraction. It's a fraction. It's gonna give you a decimal, and usually the ones that are closely or closer to 1 are really highly correlated. The ones that are closer to 0 are usually don't have any correlation, and the ones that are closer to -1 are inversely correlated. So if you wanna, I've read some books that people find or try to find stocks that have 70% correlation or better. But in this case, I really like the ones that have more than 90% correlation. So what you want to do is once you have done, if you type this in for the coral, just hit enter. So as you can see, this one has a 0.9735 correlation, which translates to 97% correlation. So these two stocks are highly correlated. So the next step would be, what I do is I do just type in how many RSH divided by ZNGA, and then we're gonna do the same thing for ZNGA. So ZNGA divided by RSH. So basically what I'm doing here is basically saying, I don't know if you guys are familiar with Forex, but like say you have the euro dollar, you'll basically see euro over dollar, which is like 1 euro equals X many dollars. And whatever the price is for the euro and the USD is basically saying 1 euro is worth $1.30. So we're going to basically try to calculate, we'll calculate that and then graph them and then see what we can infer from that. So RSH divided by ZNGA is just basically the closing price for Radio Shack divided by ZNGA price. Hit enter. Double click it. Actually, just gonna have to drag it. And do the same thing for the ZNGA. So ZNGA divided by Radio Shack. It's gonna give you a fraction. That's gonna give you a decimal, and then double click it. So what does this mean, right? To take a better look at this, we're just gonna graph them. So click on these two, and also click on dates, on the dates. So what we want to do is hit line charts. Okay, so we're gonna get a, a chart that looks like this. We'll just move it to another to the other sheet that we opened, a blank sheet, and open this up a little bit. So now what does this mean, right? Again, we take a look at our legend here, and whichever one is on top is basically the stock it represents relative to the other one. So this red one here is basically ZNGA, and the blue line here represents Radio Shack. So what I wanted to do, or what I wanted to see, is how we can profit from this. And I went ahead and saw that the two stock prices crossed one a lot after July 25th. So I went ahead and looked all of these dates up and tried to figure out what I can do with them. So it turns out that whenever you get whenever you get something below 1, it means that you would want to buy that stock, and something above 1 just means you would sell something or sell it short relative to the pair trade. So what I mean by this is that, say if I wanted to start a pair trade at this point here, I would simultaneously sell one of these, the ZNGA. So I would buy Radio Shack, and sell ZNGA at this date, on this date here. And whenever they cross 1, I would zero them out, or I would sell Radio Shack, and I would close my ZNGA trade whenever they crossed 1. And what this means is that just because they're highly correlated, whenever they're below 1, it just means to me that they're underperforming. So I would want to buy that underperforming one. And whenever something is above 1, it just means that it's like outperforming, or that it's a good short position to take just because it's gone up too far. And sometimes you get several signals, several times that they cross 1. And this one's a really good one that I chose. You get a lot of opportunities here throughout the year. And what I did was I looked up the dates whenever they crossed to see whether this was profitable or not. And it turns out that they actually work out really good. So I went ahead and did all of that. So as you can see here, I just whenever they were below, whenever they crossed, I took the date and I checked what the closing price was for that date. And then whenever they crossed back, I took that date and calculated the stock price. And if you did that for all of these points, whenever they crossed 1 at these various points here, you would get, I just plotted them. So like say for July 25th, 2012, if you were to take this closing price and you infer that it's underperforming because it's below 1, it's below 1. So what you wanted to do is buy it and simultaneously sell ZNGA 1. And then whenever they crossed each other, you would close the positions out. So basically, you would have bought Radio Shack on July 25th, and then you would have sold it on August 2. And whatever the difference was your profit, because you were basically buying this one, selling it here, and then shorting ZNGA, and then buying it back down here. So it turns out that if you were to do this for all of these, they're actually pretty profitable. Sometimes you might, like say, this was so we'll take this example, the very first signal we got. So if we would have bought a Radio Shack on July 25th, it would have cost us $2.60 per share. And if we would have sold it on August 2, the closing price was $2.79. So in that sense, we have pocketed 19 cents. But we want to just hedge it by shorting the ZNGA. So ZNGA on July 25th was at 508. So that's what I wrote here, 508. And if, when they crossed, it was at $2.70. So the difference is your profit. So again, you would have pocketed $2.38 plus the 19 cents from the Radio Shack. And if you were to calculate those every signal from July 25th, 2012, you would have made $3 for $3.13 for one stock, and $4.94 for the other one. So the grand total is $8.07 for both of these. So as you can see, that's really good, because you are not only buying underperforming stocks, but also selling the really outperforming ones. And you're hedging yourself and for the most part, they are profitable. Sometimes you might get like I guess a downturn where a drawdown. I'm sorry, but they're usually not that. They're not that expensive relative to what you're making. We'll take a look at this example. Like you made 25 cents on one side, but then you lost a penny on the other one. So again, not too bad. You basically made 24 cents on this trade, on this pair trade here. Another one was this one here. You made $1.11, but in turn you hedged yourself and lost 25 cents. So again, the difference is what you profit. So for the most part, you're making money on both sides, but sometimes you might lose on one. But I have never seen a trade that loses on both of them. So, I mean, this one, Radio Shack and ZNGA work really good, just because their prices are relatively similar or the same. So, if you wanted to like take this trade for example, and you only had like $5,000 in your account, you would want to spend 25,000 on each one. So since the prices are relatively the same, you would have relatively the same amount of shares in your account, whether you're buying or shorting. So that's why I like this strategy here. And again, it's very safe in the sense that you're hedging yourself, and if something bad happens, I mean, you're shorting one, you're protecting yourself with being long another one, or and inversely, relative to the market. I know the market's not too volatile right now, but I mean, if it does get bad, I mean, you're shorting one, and you're being long, you're protecting yourself from the on the other side. So again, if you have any questions, let me know. I hope this helps, and let me know how it goes.